Thank you for joining Bellevue University and our College of Business and welcoming our distinguished business panel today. I'm Dr. Kevin Shire. I'm a professor of finance in the College of Business. We're excited and pleased to have three business leaders with significant knowledge and experience join us to share their perspectives of the status of the current financial markets. I'd like to go ahead and introduce our guest today. In the middle, Patrick Miner is with Mutual of Omaha in Portfolio Strategies and Management Division. Pat joined Mutual of Omaha in 1992 after nearly 6 years with 2 national brokerage firms and over 7 years as the portfolio manager for Norwest Corporation. Pat is a chartered financial analyst and a member of the CFA Institute as well as the CFA Nebraska chapter. Pat's responsibilities include management of Mutual of Omaha and United of Omaha's public corporate bonds, residential mortgage-backed and commercial mortgage-backed and asset-backed securities portfolios totaling over $6 billion, and the Mutual of Omaha Bank investment portfolio. Pat also coordinates all economic studies and reports in the investment staff. He has been a speaker at insurance and asset and liability management forums and structured securities industry seminars. Pat earned his business administration degree from the University of Nebraska-Lincoln. Pat will talk to us about some of the top-down perspective issues and the macroeconomic issues in the capital markets. On your left is Mike Gallagher. Mike is Vice President of Human Resources for Harrah's and Horseshoe Casinos in Council Bluffs, which is part of the Harrah's Entertainment Group, the world's largest gaming corporation with nearly 50 casinos worldwide. Mike joined Harrah's about 18 months ago and is responsible for all HR functions for the 2 properties and approximately 1,800 employees. Prior to joining Harrah's, Mike was Regional Vice President of Human Resources for SuperValue Incorporated, the nation's 3rd largest grocery distributor. Mike worked in several HR capacities at SuperValue for over 25 years. Mike is a native of Cedar Rapids, Iowa, and is both a UNI Panther as well as an Iowa Hawkeye, having received his undergraduate degrees from the University of Northern Iowa Panthers and his JD Law degree from the University of Iowa Law School. Mike graduated with high distinction and was managing editor of the Iowa Law Review and practiced law with Iowa's largest firms prior to entering the business world. Mike and his wife reside in Council Bluffs, and he'll talk about issues regarding the gaming industry and his firm. On your right is Mr. Eric Gunderson. Eric is Vice President at American National Bank and People's National Bank in Omaha. Eric is responsible for loan reviews and serves as a loan review and compliance manager. Prior to joining American National Bank, Eric worked 14 years for Great Western Bank. His duties there included credit analyst and lender in the commercial real estate department, as well as vice president in the loan review management and credit administration management divisions. Prior to working in banking, Eric worked at HBR Incorporated for 14 years as an architect. Eric earned his MBA from Creighton University and Bachelor of Science in Management from Bellevue University. He serves on Bellevue University's College of Business Advisory Board, is a member of Leadership Omaha's Class 22, and was Coalition Chair for the Habitat for Humanity. Eric will address different current market effects on banking and the credit industry and the macroeconomic implications of the current situation. On behalf of Bellevue University and the College of Business, I would like to express our appreciation to Pat, Mike, and Eric for joining us today. I'd also like to recognize their firms and thank them for their role they play in enhancing our College of Business, as all 3 firms are represented on the College of Business Advisory Board. We'll go ahead and get started, and each individual will talk for a few moments, and then at the end of the session, we'll have time for question and answers, so please make some notes as we go through for questions. Patrick, if you'd like to go ahead and talk.
I'll start with a disclaimer that most of the opinions I'm going to express today are my own, not necessarily those of the company. Some people in the company listen to them, but maybe not everybody, so I just had to get the disclaimer out. When I thought about coming to do this, I thought I could make some nice slides and some charts and update you on things that are current, but I realized I had to change the charts twice a day before I got started, so I probably have to stick to pulled out some slides from a presentation I made to our board back in May. I did that for two reasons. Number one, they were already prepared. And number two, to focus on the fact that this isn't a current crisis. This isn't something that happened just recently. This is something that's been building for a long time. It's actually been over waves over a period of time, really for 2 years is what's brought us to the point that we're at now. And using some somewhat dated slides, I thought maybe help reinforce that opinion that this has taken a long time to develop, and it's going to take a long time to get better. A lot of people call the situation we're in a subprime mortgage crisis or a mortgage finance crisis, and I tend to refer to it as something much more broad than that. It's really a financial crisis of a different sort. Subprime mortgages was certainly the trigger that started the demise that we're in, the problems we have right now. It caused the recognition of the undercapitalization of the financial industry, caused the recognition of excess risks that were taken by investors and the financial service industry over the last decade. So it's really more of a financial, and now it's become a global financial crisis that was triggered by subprime mortgages. Subprime mortgages maybe is the poster child because it's the most evident and probably the best application of finger pointing that we can come up with at this point in time. But it really was nothing to trigger to an overall bigger problem. It's led to a lot of capital shortages, massive global delevering. I'll get into a little bit more about that later. That's going to continue for some period of time. Restriction of credit availability from the top down, from the largest financial institutions in the world to the small individual trying to get a loan at the bank, which is much harder now than it used to be. Much harder now than it was 6 months ago, 12 months ago, really over the last decade. There's been a tremendous repricing of all risk assets. I'll read about that in the newspaper, starting with stocks, the big declines we had in the stock market. There's also been a repricing of credit risk in terms of fixed income investments, corporate bonds, structured securities, mortgage-backed securities, bank loans, which maybe you saw the headlines this morning, the large bank in Iceland failed and was taken over by the government. Their biggest problem was bank loans, large bank loans for leveraged buyouts across the globe, and it finally caught up with them. And even commodities, however, that's one exception where we actually had an increase in prices. As the repricing occurred over the last several years, commodity prices kept going up and put additional pressure on the financial assets. And of course, finally, real estate, where there certainly has been a significant repricing, not only in the United States, but also in Australia and Europe, especially in England. There's been a significant decline in real estate prices abroad as well as the United States. And as I mentioned earlier, this is a building process. This has gone on for a long time. Home prices in the U.S. effectively topped out in late 2006. So it's been 2 years. Home prices have been coming down for 2 years. We've had really 4 distinct waves in this crisis. The first one started in August, September of last year. There were that's really when the subprime issue came to the forefront. It was exacerbated by some accounting rule changes by the Federal Accounting Standards Board that started to force institutions to price their assets at what they call fair market value rather than book value, or the value they put the assets on the balance sheet. That then exacerbated the problem and made people realize that they had to overvalue the assets on the balance sheet and start to realize that their capital does